think the Fed is going to have to decide between two policy mistakes.
There's a lot of discussion about a looming recession, and the bottom line is a recession is inevitable.
I do continue to believe that a soft landing is an unlikely outcome.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Very good morning and welcome to Bloomberg Surveillance, the Early Edition. I'm Manus Cranny in Dubai, sitting in for Francine Lacqua. Here's what's coming up on the program today. Under control, China reports the fewest new COVID cases since March. Authorities relax curbs and outline new stimulus measures. Markets go risk on. European stocks climb after Wall Street posts its best week since November 2020. US cash markets are closed for Memorial Day. Plus, embargo stalemate. EU nations fail to agree. A new energy sanctions package against Russia. A two-day leaders summit kicks off today. Very warm welcome to the show. We're in full risk on mode. You've broken 7 weeks of a downtrend in US equity markets. There are COVID zero relief measures in China, which are bolstering the overall risk narrative. You've got European stocks up 0.75%. Technology leads the charge up 2.33%, and the dollar rolls down by 1/8%. There is a wonderful narrative from Bank of America. The summer rally bandwagon is growing. Peak CPI, peak yields, peak dollar, peak Fed, all building into this risk-on narrative on payrolls week. Let's see whether the PCE and the inflation narrative really does roll over and that the Fed can then move to pause mode. Oil rallies by 0.75% as Europe prevaricates. Let me show you the European market map and where we are. Inflation readings coming in on Spain a little bit higher than anticipated. But you can see the momentum is building in terms of the flow of money. Bank of America say you saw $20 billion flow into equity markets last week. The biggest inflows in 10 weeks, although we did put $28 billion into cash, way more than stocks. The driver of risk this morning is China. They're trying to boost the economy by easing some of the strictest virus controls in Beijing and Shanghai. That's as the outbreak eases with the fewest new COVID cases in almost 3 months. Now, at the same time, the support measures for companies in China's financial hub are also being unveiled. Let's get to our chief Asia economics correspondent, Enda Kearney, standing by. Enda, in terms of the economic outlook, this is about mobility. This is about relief in terms of getting back to whatever normal is. So just talk us through what it might mean for the economic outlook.
Well, exactly, Manus. It's something of a near-term relief at the very least. That is, COVID cases in Beijing and Shanghai have now collapsed. That means Beijing is probably going to avoid the kind of lockdown that Shanghai went through in recent months. They are easing restrictions in Beijing, and now they're easing more restrictions in Shanghai. For example, they're allowing manufacturing to get motoring again the way it was before the lockdown began. And of course, they're also rolling out some extra measures to support, for example, property investment, some measures to stoke buying new cars in Shanghai, for example. So they're rolling out some support for the economy as well. But the big takeaway is that this very aggressive control of COVID that China has pursued in recent months in Shanghai and Beijing looks to have controlled the virus for now. They are easing restrictions. That's obviously good for the economy. But the question is, can this last?
Well, certainly lit a new momentum in the oil market as well, hasn't it? The question, Enda, is this. It's about momentum and continuity, isn't it? So even though we have these moments of relief and mobility, is it a game changer? That is what the global markets need to ask themselves.
And Manus, I think most people just looking at this would say, how realistic or how sustainable is China's aggressive COVID zero policy going to be, given what we all know about how transmissive the Omicron variant is and any other variants that might come after it. So there is a view from some experts that Shanghai and Beijing are in a good space now, but X months from here, they might be back to where they started with the virus spreading. And what do the authorities do then? Do they continue to roll out these kind of restrictions that curb mobility and with all the impact that has on consumption and manufacturing? And I think that's where the China story is right now. Nobody yet has the confidence to say, all clear, China's set to have this kind of V-shaped rebound that it had in 2020. Most economists that we speak to here say, look, it's kind of like wheels spinning in the stand a little bit still. Good news on the virus front, but how long can it last? They're throwing stimulus at an economy that it keeps switching on and switching off.
Yep, and that is a global debate in terms of the pace that we reopen. We've all been through it. Europe, the Middle East, and of course in the US. And thank you very much, our Chief Asia Economics Correspondent, Enda Karan. Well, this week's MLive Pulse survey is focused on the Chinese economy, a look at what investors anticipate from the nation's COVID-0 policy and the impact on markets.
I like China.
Many people calling it uninvestable, but there's also a very wide margin of safety.
September, October, they will start one of the biggest fiscal impulses in human history.
We've turned the corner in terms of policy action, and that should be supportive for markets.
And there's also a possibility that they reopen and that they stimulate the economy.
Probably is the part of the world where you'll see economic activity resume more quickly.
A lot of the attractive long-term growth drivers are still intact. We will be cautious and prudent in this environment, but are optimistic about China as a country.
We're expecting to increase our exposure in China.
I actually just see a deepening of relationships into China.
Let's add to those roll call of voices. It's Erik Nielsen, Chief Economic Advisor at Unicredit. Erik, great to be with you. A long time since we've had the opportunity. Time zones keep us apart. We're desperate to get back to normal on everything, aren't we, Erik? We're desperate to get to 5%. We're desperate to get to 2% inflation. You say it's a long road to normality. Listening to those voices, what is it that will deliver 5% growth in China, and is that what we need?
It would be wonderful, Manos, to get to 5% growth in China. I just don't see it coming back. China is fighting a number of issues, including, and most importantly, a long structural decline in the growth rates simply because of demographics. Then you have the real estate bubble, huge leverage, which they are trying to maneuver. And then on top of that, the COVID, where there's some good news, as you just talked about. But I think, generally speaking, the Chinese growth rate is on a declining trend.
Where do you think that declines to? We've had many pieces of research, Erik, from 2-3% from Nomura, etc. What would you say, Manas, a worst-case scenario would be X this year and next year?
I don't know. For the simple reason that I think they smooth their growth rate numbers published too much to really have a debate about exactly what quarter will come out with what number. But I think you're looking at sort of this 4-5% range, and then if you look 3, 4, 5 years out, I think you're down at 3% maybe, or thereabout. But this is the direction it goes without almost any doubt, I think. I mean, the idea of coming back to 5, 6, 7%, I think it is an illusion.
Well, that illusion, just listening to some of the voices there with KKR, with Goldman's, etc., but it's almost as if there's this expectation, Erik, isn't there, that we're going to have this mother of all fiscal stimuluses. Now, you, me, and a number of people have lived through the mother of all stimuluses in a variety of ways. What kind of stimulus do you think is most constructive to underpin the growth in an economy which is coming out of something we've never lived through before in China, which is a complete shutdown and COVID?
Yeah, no, that's a good point, and I don't know the answer. I used to think when we came through the COVID crisis that European fiscal way of stimulating was better than the American. The American, as you know, just sort of put a lot of money into the society in cash, where Europe preserved jobs. I think the jury is out, and if anything, maybe I was wrong on that, and the American way was more effective in pushing the economy back up the V-shape you talked about. So I think if I were an advisor to the Chinese government, which I'm not, I think you would want to look at ways of putting cash into the hands of the less well-off, those with no savings ratio. So I think that would be the way. But again, that's a short-term stimulus. It's not a structural way of dealing with the economy, right?
Indeed, and I reflect on part of your notes. You were talking about the geopolitics of Russia and Ukraine, and we'll talk about that in a moment. My assessment is there's practically no chance of a return to anything even remotely similar to the world that we enjoyed for the past 30 to 40 years. Erik, you've just crushed my career. Now, the point being that I want to pull up there is really, it's what happens next with globalization. And this is something which we will debate, I think, more and more as the year goes on in a post-COVID China world. Onshoring, bringing it back home to the US, UK, etc. Is that something which we haven't quite understood yet? The longer-term supply chain repercussions in a post-COVID world. It's a big topic, but is that in part what you mean?
Yeah, Magnus, I think this is exactly right. It is too many businesses and too many leaders in places like Germany keep saying we are coming back to some sort of deglobalization because we can't live without the supply chains and things will be coming back towards something like normal. I don't think that's realistic for a number of reasons, as I discussed in that note you referred to from yesterday, where I'm saying, number one, the world after these shocks are not going to be normal in the sense of what we used to think of as normal. Chinese growth at 5-6% and all the rest of it, globalization. A lot of stuff has happened, both economically and politically in the world, and the war is the big thing, of course. And in my assessment, there is virtually no chance of Russia becoming a normal country in terms of trade and diplomatic interaction again for many, many years. And China has probably learned a lesson about this. And I suspect that they were surprised about the sanctions by the West. And this means that, in my opinion, the overwhelming odds are that China will now try to disentangle itself more and more from the West in terms of payment systems and commodities and other things, so that they gain that military sovereignty that I think they desperately want. So I think we are heading in a different direction. The transition from carbon to green was underway, but this is accelerated with the Russia policies. And that means that new normal, the path to the new normal, whatever that is, will be very rushed and complicated. So next 5 years, I think we will struggle with normality, to use that word.
Erik, goodness knows what happens in the next month to extrapolate to 5 years. I think good luck on that. Now,
fair point.
Don't you go. Absolutely. Listen, don't go anywhere, because we're going to continue the conversation about some of the risks that you raised. My guest this morning, Erik Nielsen, Chief Economics Advisor with Unicredit. Coming up on the show, we're going to live to Brussels. The EU leaders, they kick off 2 days of meetings with the Russian oil ban still at a sticking point. What will clear the impasse? We discuss on Bloomberg. Economics, finance, politics, the Bloomberg Surveillance early edition. Welcome. I'm Manis Cranny in Dubai. Leaders are gathering for the first day of the European Union summit in Brussels, with the latest sanctions package stalled. Talks over the weekend failed to break a stalemate with Hungary, which is so far refusing to back a compromise deal with Russia and the oil supplies. Our Europe correspondent, Maria Tadeo, is on the ground at the EU building. Maria, any hopes of an agreement today, or will the Hungarians just sort of hold out?
Well, Manis, the mood this morning is actually not optimistic. Yesterday, we saw that there was no deal. Again, this is almost the never-ending story. It's that fierce resistance from the Hungarians and Viktor Orban. What they say is that if they were to cut off Russian oil imports, it would have a huge detrimental effect on their economy. They're now fishing for concessions. At the beginning, the idea was that an exemption on the pipeline, so that is the oil that gets transported through pipelines, would be okay, but now it seems that they're pushing even more, potentially extra funding, but also an exemption on the seaborne, that is the transportation by sea. As I said, a lot of the diplomats that I spoke with yesterday, but also this morning, they say that this is a very complicated one. It's also a very technical issue, and the mood this morning, as I mentioned, is not optimistic about a deal.
Okay, Maria, thank you very much. It looks as if you're going to have a late one there in terms of tracking these news releases. Let's see what an elegant compromise might look like. Maria today there in Brussels. Let's take that discussion to Erik Nielsen, Chief Economics Advisor with Unicredit. Erik, nobody ever thought that they would cut off, or go towards cutting off oil from Russia or gas from Russia. How real is that probability of getting that delivered? And what is the impact, the real impact for Germany? They've switched off nuclear. They're way behind in terms of being able to actually really grapple with this situation. So just take me through the reality of getting anything like this over the line.
In the short term, I don't think it's realistic at all. I think you can end oil imports by the end of the year at some sort of cost, as there's been discussed. A lot of research has been done in Germany or for Germany on what it actually means to cut off the Russian energy. And the estimates vary. They're all over the place. The most optimistic say it's just a -1% or thereabout, but it goes all the way up to maybe -10 or thereabout. So I think it's understandable, in my opinion, that the government is hesitant. It's also unclear what it actually will do to the war. And this, I think, is not being recognized sufficiently by those who advocate a very fast end to the energy of Russian energy. Because the reality is that Russia has been able to run an increasingly big current account surplus because they're sending the oil elsewhere at much, much higher prices. And therefore, in a sense, you could argue that Europe may be shooting ourselves in the foot to some extent. There's a moral issue. Do you want to buy anything from Russia these days? And also, I understand all this. But in a realpolitik way of how do you best react to this, I have some sympathy for the German line on this. It's a long way before we get any sort of agreement, I think. And you mentioned Hungary. The problem is, as you know, in Europe, we have veto rights, and even a small country with questionable legal standards can stand in the way.
Well, that sometimes is the power and sometimes the detraction of Europe. Erik, the ruble is up. At one stage, we rallied as much as 5%. Those oil dollars roll in. That bolsters the FX story, even though everybody shouts at the screen, oh, there's nobody trading Russian ruble. Why are you talking about it? But it's a reflective position in terms of what is going on there. I want to close off on FX. The world and its mother in here telling me I was going to parity on euro. That seems to be, a hard call at the moment. The ECB will welcome the bounce in the euro. Is parity just a bygone discussion? Do you think we can return to parity? What's the next break on the euro?
I have for a good long while thought there was a very high probability we'll go through parity. I have written a few months ago that probably between 95 and parity. It's not going my way these days, but I still think this is the direction. We are bouncing a bit. You see also stocks going back. I think that's more like a short-term bounce than a turn. So I think the reality is that the US is doing better economically, and as you just referred to more on the political side, Europe is not really on the right path in terms of having big political decisions to this new non-normal world, right? In terms of investment policies and unity and we can. There's a long story, but you are familiar with it. Europe is too slow, and the ECB is tightening a little bit, but not nearly like the Fed. So for me, it's still parity coming up in a few months. But
parity, baby. Parity baby by Nielsen. I'm going to be very cheeky. I'm going to squeeze one very quick one in. What's the risk of a 50 basis point hike? Is it even possibly on the table?
Within the next two meetings, virtually zero. It is if ECB goes 50 in July or September, Christine Lagarde's credibility is gone. Frankly speaking, she did a fantastic block last Monday, and she put down the foot. If that comes off, then all guidance is off, right? But so no chance of a 50 in July or September.
Erik, the reason why we bring you back so often, because you can cram a powerful answer into 30 seconds. That's a skill honed over 12 years. Erik, thank you very much. Erik Nielsen, the Chief Economics Advisor at Unicredit, my guest this morning on all things Europe, oil and currencies. Coming up on the show, we're going to talk alternative assets in a time of inflation. We speak to the chairman of Mintos, an art investment platform, right here on Bloomberg. Economics, finance, politics, the Bloomberg Surveillance early edition. I'm Manus Cranny in Dubai. Let's get you first word news with Leanne Gerrans at London HQ.
Manis, good morning and great to be here. Ukraine's President Volodymyr Zelensky has visited troops in the Kharkiv region over the weekend. It was his first publicly known trip outside of the Kyiv area since Russia's invasion. Zelensky handed out state awards to soldiers and was briefed on the operational situation. Officials say more than 30% of residential buildings in Kharkiv have been damaged by Russian attacks. Now, right here in the UK, civil servants have reportedly warned the government that around 6 million households could face power cuts this winter. The Times newspaper is reporting that electricity could have to be rationed at the start of next year if Russia cuts gas supplies to the EU. UK Energy Secretary Kwasi Kwarteng is urging the national grid to find a deal that would help keep some coal-fired power plants running this winter. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Under control. China reports the fewest new COVID cases since March. Authorities relax the curbs and outline new stimulus measures. Markets go risk on. European stocks climb after Wall Street posts its best week since November 2020. US cash markets are closed for Memorial Day. Plus, embargo stalemate. EU nations fail to agree on new energy sanctions against Russia. A two-day leaders' summit kicks off today. Good morning. Warm welcome to Bloomberg Surveillance, the early edition. I'm Manis Cranny in Dubai. We have a firm risk-on mode as Shanghai and Beijing step back from their max zero-COVID policies. That gives a nice boost to the risk narrative. You're talking about stimulus coming through as well in China. Europe gets an uplift. You've got oil and energy stocks, technology, all doing a little bit better across the risk this morning. You can just see that on the boards this morning. So let's talk about the data. Spanish inflation unexpectedly quickened this month, denting any hopes that the Eurozone's record pace on the surge that we've seen there has peaked. That piles more pressure on the ECB to act. Bloomberg's estimates for Eurozone inflation to tick up to 7.8% in May, and all eyes are on Madame Lagarde ahead of the central bank's crucial policy decision next week. We have our European economy reporter, Alexander Weber. He joins me now. Alexander, thank you for being with me. We've had the Spanish numbers. They were a little bit higher than expected. Now, that doesn't set a great stage for the pan-European numbers to come. So just talk me through the acceleration in Spain. What does it mean for the broader read?
So the acceleration in Spain was driven by fuel costs, but you also saw that underlying inflation, which strips out energy and food, also quickened. That means price pressures are broadening, and that's really not a good sign. It also means that the euro area probably isn't as close to peaking as many have perhaps hoped for. And we're getting also German data later today. We already have regional data from the most populous state in Germany, which also saw an acceleration by more than expected. So it's just one of those, another surprise, and these surprises just don't seem to stop. And we've seen in the past that that can really make leave a lasting impression on ECB policymakers.
Well, let's just talk about what it means for the ECB. Last week, Lagarde put out her blog post. She spoke to Francine. We're not in panic mode. And then Lane comes out again today, the chief economist, to say the benchmark, I think the language is the benchmark pace is 25 basis points at both July and September. Now, there's this growing discourse of around 50 basis points. Erik Nielsen said if they went for 50 basis points, Lagarde's reputation would be, face down. So what is the risk of 50 basis points? What makes them panic to 50?
So we've heard from a few governing council members that 50 basis points should at least be considered, and they've pointed to inflation data as perhaps the key input for that decision. So they've said we're getting 2 more months of inflation data readings until July. And if those are coming higher than expected, then it could strengthen the case for 50 basis points. But as you mentioned, Lagarde set out a charted a course that means 25 in July and September. So the case is rather high. But on the other hand, we've also seen how quickly things could change, with especially with surprising data like we've seen in recent months. And what used to be a very hawkish position in the Governing Council has really become mainstream. And the timing for liftoff has really moved forward in recent months. So I wouldn't rule out a 50 basis point increase either if we're getting more, especially if underlying price pressures continue to grow. And that could sway some of the more centrist Governing Council members as well.
Okay, let's see over the next couple of weeks. That narrative is going to shift a little bit. Economy reporter Alexander Weber on the ECB and inflation data. Facing prolonged inflation, investors increasingly turning to alternative assets. Just 10 days ago, 1955 Mercedes-Benz Coupe sold for $142 million, a sign of just how sought after these assets have become. But the price tag also demonstrates that many of these items remain available to a very few number of people. My next guest runs an investment firm, which is trying to make the art world more accessible to investors. Mintos makes it possible to buy shares in companies that own high-end pieces. It's a platform. It's currently offering investors exposure to pieces from artists such as Andy Warhol and George Condo. We're joined now by the chairman of Mintos. It is Maarten Slendebroek. Maarten, thank you so much for being with us. I mean, you're the chairman of a 200 billion euro asset manager, Robeco, former CEO of Jupiter Fund Management, and here you are bringing Mintos to the millions, let's say. Who are you targeting? And more importantly, how big can this business become? Good morning.
Good morning to you, Manus. Well, we're talking about people who like art, but we're also thinking about people who see art as a financial investment. And of course, Mintos is not an NFT. We offer real shares in real paintings. The company is FCA registered with all the protections that come with that. And so we're aiming this at individuals as much as also to wealth managers and insurance companies.
I mean, I love the story and I love the concept because, you know, you talk about how do you diversify and, you know, I'm probably in a demographic that is paranoid about inflation. So is this a very beautiful and elegant optionality to Bitcoin and gold?
The way I look at it, and man, as you know, I come from the traditional asset management world. This, of course, is an alternative. And in the background of this company, you need to think about making items available for a broader public that weren't available to them before. And I'm sure you walked through a gallery, looked at contemporary art worth tens and tens of millions. It is not available, not even for very rich people. This makes it possible down to a lowest ticket of £2,500 or dollars to buy an item like this you see on the screen right now, which is a self-portrait of Andy Warhol. But following these paintings, we have about $150 million of other art lined up to come to the market as well.
And how big, I mean, this is where I want to get a sense. I talked about the Mercedes car, such a unique piece, 1955 300 SLR. There only were two of them. And it went for $140 million. How tight is the art market? In other words, you need to buy collateral to offer to people like me. I'll be the $2,500 ticket, Maarten, as opposed to the $1 million. How tight is that market? How tight is that art market when I see frenzied bidding on cars?
Yes. Now, I like alternative assets and including cars as well. But the art market is a 65 billion market a year. So it's 65 billion in that market is traded annually, of which about a third at auction. We believe that there is sufficient liquidity in this market to buy and sell. Obviously, every piece of art is in itself an original and cannot be directly compared to anything else. But there have been many hundreds of trading points, for example, of Andy Warhol obviously one of the best traded artists in the recent 30 years. But there are others coming up as well. So this market is much wider than just that unique car you referred to. And I think it has broader application than that.
You made the point very clearly about the distinction between it's not an NFT, it's an actual share. And the thought that went through my mind is the valuations. These are the Warhol prints of Monroe that we are showing along with others. The valuation, so I get my $2,500 participation and equity participation in a Warhol. Are you going to mark to market the art on a monthly, on a quarterly basis? How liquid will my holding be in Mintos?
Yeah. So the idea when you buy art is not to trade it. It's not an NFT. The plan is that you hold on to it. We have a former chairman of Christie's and a former CEO of Sotheby's as advisors on our advisory board. We have also appointed a third-party individual valuer of art who will annually reappraise all that art. But the idea, of course, is not to make this something that trades on a daily basis.
Where do you think the biggest market is going to be in this, Maarten? Is it going to be US? Is it going to be the Europeans? Who do you think has the biggest desire to get their hands on this? I absolutely love this idea.
Look, the interest is everywhere. In the US, this already exists as an idea. We are the first one in the UK and in Europe to kick this off. There's a lot of interest in Asia. And you will not be surprised to hear that big wealth managers, both here and in the US, are phenomenally interested in this area as a broadening, a diversification of their offering to their customers. So I think it's truly worldwide. The idea of investing in art is already well established out in Asia too. So really, I think the market has its limitations. 65 billion is a lot. But that's at the same time the limitation of the total marketplace we're operating in.
Maarten, we wish you well, and we look forward to hearing the valuation in 1 year's time. Maarten Slendebroek, chairman of Mintos and Robeco, my guest this morning on an ever-evolving art market. Coming up on the show, China's Netflix-style video streamer iQIYI says it's moving to prioritize profitability over market share. Don't miss our exclusive interview with the CEO, Gong Yu. That's next on Bloomberg. Economics, finance, politics, the Bloomberg Surveillance Early Edition. I'm Maarten Slendebroek in Dubai. China's Netflix-style video streamer iQIYI says it's moving to prioritize profitability over market share. The company has lost about 70% of its market value since its 2018 debut amid the broader tech sell-off triggered by Beijing's regulatory crackdown. The CEO and founder, Gong Yu, spoke exclusively with Bloomberg's John Liu about the change in strategy.
Seeking market growth should not be our strategic priority anymore, because this industry has developed into a relatively mature one that's at a slower growth stage.
iQIYI in November of 2020 raised prices, and then raised prices again in December of last year. How much room do you see to raise prices again additionally?
The price hike potential still exists. Whether we will raise the price this year, we will see how markets react. We don't have a clear plan yet.
Where do you see advertising revenue going the rest of the year, and where do you see the economy going the rest of the year?
For the second quarter, almost entire Shanghai is under lockdown. For those who understand brand advertisement industry, they know half of China's brand advertisement marketing is based in Shanghai. So we will see bigger negative impact on brand advertisement in the second quarter. In my opinion, Q2 is the bottom. The end of Q2, which is current stage, we will see gradually recovery. The third and fourth quarter will see growth.
So you expect the impact from the regulatory environment to moderate, to become less noticeable going forward?
Last year, there was regulatory scrutiny. We are not afraid of regulation, but the transition period is painful. Let's say regulation was this way last year, and then this year it changed. It's that transition that is relatively painful.
Back in 2020, there were reports that both Alibaba and Tencent were interested in buying stakes in iQIYI. Is that still something that's possible?
This is a rumor. There have never had any conversations with Tencent and Alibaba about investing in iQIYI investment banks. Some people or media did ask my opinion. My response is it's not possible.
At the end of March, the SEC placed iQIYI on the list of companies that could be delisted because of the auditing dispute between the US and China. And at the time, iQIYI said it was working on solutions to protect its stakeholders. How is that process going, and how likely do you think a delisting could be?
I hope the dialogue between China and the US will make some progress to resolve the issue. At the same time, we are looking at other opportunities to reduce the risk. We are working on technical issues for Hong Kong listing, but there is no specific timetable yet.
Giving us a better picture of what the economy is looking like at the moment, from iQIYI's perspective, what does consumption look like in China?
The service iQIYI is providing is very special. It is a low-spending online entertainment industry. Our business is not highly correlated with the economy.
That was the CEO of China's Netflix-style video streamer iQIYI Gongyu speaking exclusively to John Liu. I want to give you a snapshot of risk. It's the bond markets that are moving. You had a higher inflation print from Spain, which has really irked the bond markets, most specifically the German bond markets. Hone in on those sovereign curves and you begin to understand the move higher that you're seeing both in terms of Swiss rates and German rates in the belly of the curve on the 5-year paper is where the real material move is. You see CPI come in at 8.7%. The estimate out there was for 8.5%. I just want to show you the ramifications on the bunds. Now, obviously, cash markets are closed in the United States of America. You are looking here at German yield rising in terms of the actual move that you have here. Now, the market is beginning to price in a tighter ECB. 100 basis points of tightening this year, 32 basis points of tightening in July. As Philip Lane said, 25 basis points is the benchmark pace. The bond market has a slightly different opinion. Okay, let's get into the business flash headlines. Leanne Gerrans is standing by in London. Leanne.
Manus, good morning. The US corruption and market manipulation cases against Glencore have shed light on the conduct of 2 former executives who walked away as billionaires. Authorities have not brought any charges against top Glencore managers in the sweeping cases against the firm, but have identified 2 alleged perpetrators of corruption. They include an ex-global head of oil and a former head of copper. Now, Telecom Italia has reached a preliminary deal with an Italian state-backed lender for a national single network fixed line project. The carrier signed a memorandum of understanding with Cassa Depositi, its second largest investor, to combine Telecom Italia's grid with a similar network owned by smaller rival Open Fiber. Under the accord, Telecom Italia's fixed network infrastructure activities will be split from its commercial activities. And finally, Top Gun Maverick has smashed the weekend box office, taking in an estimated $124 million in ticket sales in the US and Canada. The movie gave theaters one of the biggest box office debuts since the start of the pandemic. A rare movie and a rare move for a non-superhero film, but it is unlikely to be released over in China, diminishing its global returns. And that's your Bloomberg Business Flash. Manus.
Leanne, thank you very much. 1986, it was a vintage year. I went to university. I mean, that's when the first one came out. But when we look at this one, did you see it over the weekend?
I just want to say it was a vintage year when you went to university, but it was the best year for the whole world because it was the year I was born, Manus Cranny. I'm a 1986-year-old baby. So you were going to university. Leanne Gerrans was born, as was Top Gun. And we've all been wearing aviators ever since, haven't we?
Absolutely. I mean, I have one in sort of dust wrap somewhere in a cupboard at home. But on a slightly more serious note, and I thought this was great. So it took $124 million, less than Batman. But this is the one that I like the most. Leanne, over the weekend, Cruise and Paramount, 55% of the audience were over 35. This was the biggest ever for this was the biggest ever for Tom Cruise.
Yeah,
but of course, it's Lady Gaga wrote the theme tune here.
Oh, did she? I haven't heard the theme tune. Am I missing out? But I desperately want to see this. And as you say, it's the biggest grossing film for Tom Cruise at an opening weekend. So, I mean, he's come back bigger and better 36 years on. You know what they say about age, Manus?
What, Leanne? Tread carefully. Yeah, I mean, I suppose that the fact that it didn't get to open in China is the one thing. It's interesting. Tencent originally signed on, but then they pulled out because they felt, we understand from sources, that it glorified the US military. That's according to the journal. Leanne, thank you very much. I'm going to book in and see it hopefully this weekend. The return of Tom Cruise at high speed. It's a bit like Surveillance, the early edition. Coming up on the show, the bull market in battery metals is over, according to Goldman Sachs. Why? We'll tell you right here on Bloomberg. Economics, finance, politics, the Bloomberg Surveillance Early Edition. Welcome, I'm Manus Cranny in Dubai. My chart of the hour comes from Robin Brooks. How much are you paying for your mortgage in the United States of America? It's Memorial Day. You're probably having a small break. But I want you to reflect on this from Robin Brooks. Exploding. He's calling a global recession, Russia, Ukraine, China lockdowns, but it's the disorderly rise in the real mortgage rates that's going to cause an implosion in the US housing market. This is the ramping on 30-year mortgages. The big round dot is the 2013 taper tantrum. This is the seeds of doubt in the mortgage market in the United States of America. Leave you a quick snapshot of risk. I'm with you for another hour. You cannot get enough of it. In terms of risk on, stocks are rising, money's flooding in to the equity markets. We broke 7 weeks of losses. Yields are rising as we go into jobs week in the United States of America. 10-year futures, cash is closed. Futures trade down in price, up in yield. More to come. This is Bloomberg.